companies operating in the global economy, you have two sets of issues. You've got the macroeconomic outlook, depending on what part of the global economy you're looking at. And then you've got your own supply chain. And that, those things are configured differently as you go from company to company. So we'll probably want to talk about both of those things. So to go to your question, why don't we start with the United States? I think all the indicators are flashing, bright yellow at this point. We won't kind of have an exhaustive list, but, consumer confidence is declining. CEO surveys suggest confidence declining. Uncertainty indices are sort of off the chart. People expect at least some kind of bump in the inflation horizon. There's some turbulence in the financial markets, kind of comes and goes, but, we've had one relatively dangerous sounding, episode with the Treasury market a week or so ago. And so I think in the United States, the knowledgeable financial folks are telling us the probability of inflation's rising. Some of the CEOs focusing on their own business say it's already here, and so on. So I think, that's an area where you can be at least a little more confident, because the uncertainty itself is causing a fair amount of the problem. It's causing cautionary behavior on the part of both companies and consumers and kind of everybody else in the system. And so I think, when you're looking at the demand side, again, sectors and so on differ. You can probably expect a bit of a surge. The smart buyers and the smart suppliers are kind of piling up inventories before the hypothetical tariffs hit, as a kind of, defense mechanism. And I think the proposition that's being, talked about is that, if these things actually go into effect, right, the negotiation processes don't work very well or take longer than the 90 days, and this back in the uncertainty. You're talking about real problems in the economy as opposed to sort of damaged expectations coming, 2-3 months from now. When the containers don't arrive on the West Coast, or they arrive empty or something like that. So yeah, I think if you focus on the United States, it's kind of looks ugly. I mean, it depends on whether the United States decides, that they want to kind of interfere with that somehow on some, national security, or, this is our hemisphere kind of attitude. But I think that's uncertain, and I'm optimistic about Latin America on the whole. Everybody has challenges that they have to deal with, but by and large, these have competent governments, and I'd be looking hard at that for sure.
Right. All right, terrific. No, I guess one of the things we discussed the other day is the reorientation of the world trading blocks and how they might migrate. I mean, we all understand, Mike, obviously nobody can predict this, what's going to happen here. But I think if you start with the assumption that the U.S. is starting to withdraw based on populism, and they feel that they're can isolate themselves from the world, which you and I know economically that doesn't work, needless to say, because the U.S. economy doesn't grow fast enough to grow the standard of living for its population. But assume these people who are saying these things continue down this path. How do you see the world reorienting, and then therefore what opportunities does that open up for say future markets, and therefore companies, and how they would redesign their supply chains and their trading agreements around the world?
Yeah, it's a really important question. So, and it's hard to think about, but if you start with the premise that at least, and I view this as one of less uncertainty than some of the other things we've talked about, and that is that the United States under this administration has zero enthusiasm for multilateral structures. for the organizations that sponsor those things and so on, and we're busy kind of withdrawing from them. That doesn't mean the United States will withdraw from the global economy, but it means we're not a sponsor. We're not choosing, to be a leader in that. There may be exceptions to this. I think it's quite unclear what the United States' role in NATO will be going forward, which is immaterial with respect to Europe and things like that. But so the United States pulls back. It weakens these organizations that are the day-to-day managers of the global interdependence, the World Health Organization, the WTO, IMF, World Bank, remains to be seen whether we're kind of sponsors of those and influential sponsors, meaning we kind of decide what's going on. So, Sam, I think there's three scenarios. People often say, well, is this a period of deglobalization? And I go back to that 25%, 75%, number. And I say, well, you take 25% out, it doesn't help, but there's still 75%. And when you look at the 75%, China appears in their own way to be a committed multilateralist with probably Chinese characteristics. I don't see any sign that the Europeans, who are on balance heavily dependent on trade, are moving in the American direction. And the emerging economies are just clear as a bell, right? That the global economy is an important part of their story going forward. So there is I would say for the most part, that 75% outside the United States has a tremendous interest in finding productive ways to continue to deal with each other in terms of trade, investment, and technology. And I think they'll find a way to do it. It's the bottom line. So I don't think we're going to get some dramatic deglobalization event. And I suspect that multilateralism will survive with somewhat different characteristics, more complicated, no U.S. sponsor, somewhat fragmented, a little bit less trust, more national security overlays and all that stuff, which was going on to some extent before the Trump administration took office. But so this will be a modification of it, but not a kind of 180-degree turn.
And I completely agree with you, because the 75% is real and growing, as we all know, right? So it's the majority. And it depends from a company perspective, it depends on where you're domiciled, right? Because if you're already operating on that 75% of the world, you probably have most companies, like IBM, for example, would be running a pretty high efficient supply chain. You'd have all those relationships in place, and those systems would be working. Now, if you're domiciled in the United States, that's a different challenge that you would have, right? Because then you have to think about how do you reorient yourself. And I would use IBM as an example, and then get your perspective on that. But if you go back to about, I guess, be like 25 years ago, we saw tremendous growth in the emerging markets. At that point in time, they were single-digit percentages of our revenue. I mean, it was more than the BRICS. It was like BRICS plus 10, let's say. But fundamentally, fewer than 20 countries, there was tremendous economic opportunity. And we invested heavily. And then by the time I retired, it was close to 30% of IBM. And as you know, then we were a $110 billion company. So that was incrementally $20 or $30 billion of revenue. So, and we did that through investment and through establishing those relationships and partnerships and adding talent to those regions, et cetera, et cetera. So in many ways, even if you're domiciled in the United States and you have global capacity, you're not strictly regional. My guess is that that's what you would do. You would quietly go about it, but that's what you would do. Just go about your business and then continue to invest elsewhere and lessen your investment based upon the economic opportunities of your domiciled country. So do you have an opinion or a thought on that?
That seems exactly right. I mean, I was going to ask you the same question because you have so much experience with this, but the major premise, which is the emerging markets are an increasingly interesting and important part of the global economy, with higher purchasing power, more sophisticated economies, more needs for sort of advanced service type operations, etc. So at least a large swath of companies, ought to continue to find that that's, an open field to play on. And so I don't see any huge change in that. Probably if you go back and take over again at IBM, you'll probably find Southeast Asia, ASEAN countries, continue to be a big opportunity set. And so I think the only question is, if you're U.S. domiciled and subject to U.S. regulations, is somebody going to try to put something in your way, in terms of the investment pattern? So, I mean, I don't know. How do you see that going forward?
I go back to the things that they could do. I mean, basically, there could be some tax, regulations or bills that they could pass that would tax your foreign income, even though you're already paying foreign income. Those things get discussed a lot. There'd be those kinds of things. Maybe it'd be harder to move capital around because of constraints that they could put in place. But normally, having been through all those things, you work your way around that. You patiently work your way around those things, and circumstances tend to change over time. They revert back to where they were. Many examples of that. So there, I guess my view is, as I think about this, as we were at IBM, we would make the necessary investments where we found consistency of government was one of the criteria. So if we were worried about somebody seizing our assets, which has happened to IBM in India, in Korea, and we can go around the world, or in Japan, our assets have been seized. So therefore, we have this bias that you have to have a friendly government that's going to be in place for a while to work with, right?
Yeah.
Those sorts of things. But having said all that, that's kind of how we would think about it as a large global enterprise and those sorts of things. The other thing it kind of leads to, if I was domiciled wherever else in the world, say, for example, Asia or in Latin America, what would you move if it became, to get at market access in the United States, you'd have to have some form of an investment made in the United States. I'll give you an example of IBM post-World War II. We wanted to support those countries, but our market access after the war was building manufacturing facilities, i.e. Berlin is an example. Would you think we would have logically thought of Berlin as a place to put a plant? Probably not, right?
Yeah,
But we did.
right.
I can walk you around the world. There's like Lagode, France, a semiconductor facility in Lagode, France. But you could see why it was market access, and that's basically what we were doing. But, so that would be kind of the approach. So if you had to make an investment, now the thing, I'm going to make it a little more complicated, because as you think about investment, you have to think about emerging technologies, because it's not going to be plants today like it was in the old days, right? So you're going to have all this incredibly, and we all think profound change is going to occur because of the technologies coming out of artificial intelligence and massive computing capacity. You read that IBM just talked about putting $150 billion of investment into quantum computing, my view is they now think it's commercial after 25 years. We were investing in it when I was there, but now they're viewing it as commercial. But the broader question here is, if you're now looking to this opportunity called the U.S. market, right, and you were always relying on the ability to have free trade to get you in and out of that market, what would you consider strategically that you could locate in the United States from wherever in the other 25% of these economies?
Yeah, so that's a really interesting question. And just a couple of observations that I think help frame it a little bit. First of all, the tariffs that are being talked about are largely on goods, and services are hard to put restrictions on. Not impossible, but harder. And lots of companies and lots of countries, are kind of service built. And if you look at global trade, services are probably 30+% of global trade, and probably underestimated because the data are crappy, and growing, unlike the manufacturing thing. So I think for a lot of companies that are in the service business, the kind of level of restrictions is probably not so high, and you can go, there's still market access, and you got to go and make a case that you're contributing something there. And if you're in technologies that have a high degree of sensitivity because of overlap with some kind of security concern, whether it's data or warfare or something like that, then that's a different set of considerations that you have to deal with, like say in parts of digital, for example. In manufacturing, just to kind of close the loop, Sam, I wouldn't give up on the United States because, you know, at least one of the messages that comes from President Trump himself, although not necessarily all the other people who are involved in this in the administration, is he wants, you know, foreign companies to come and invest in the United States, in part because he wants the economic activity and the employment that goes with that. Now, that doesn't work in every instance. You know, the kind of stupid example I give people is you can't bring Bordeaux wines and produce them in the United States because you can't get Bordeaux into the United States. It just doesn't work. But automobiles is a different story, and automobiles is still a big employer, despite, you know, automation and robots and stuff like that. And so I think depending on how the Trump administration policies go, you know, rebalancing trade, you know, to make it work from the point of view of the benefits that are distributed to the population, not just in the United States, but in a lot of different places. Foreign direct investment, you know, if it's unimpeded or even, you know, a way of avoiding the tariff by hopping over them is an interesting thing to think about. You know, you know this because you know, you were leading a company at the time, but President Reagan put quotas on Japanese car imports in the 1980s because he thought they were going to blow us out of the water, meaning our companies. And sure enough, you know, the Japanese hit the quotas and then came over and started setting up the assembly operations in the United States. They avoided the Detroit area for unionization reasons, but, you know, so I don't think that's a crazy example. I mean, you know, I think we could see more of that as part of the solution to this problem. It's a pretty benign one in a way, both for companies and for countries and policymakers. Of the digital technologies we have now is just enormous, and I don't have any doubt that, or at least a reasonable hypothesis is that this kind of thing will create greater incentives and accelerate the movement in that direction. But one other thing, and that is, it is specific to supply chains, and I think the Institute is focused on this, is that most people, when they think of AI, you know, if they're not deep into the weeds on it, think of it as something that increases people's productivity. And at some level it does. But I mean, I think the really interesting use cases is when AI makes a whole system more productive, right? You know, because it enables you to manage complexity of a type that humans have trouble wrestling with because of the sheer complexity. This is the kind of superhuman kind of dimensionality of some of the AI, you know, capabilities.
Well, yeah, I mean, I was going to say, take that analogy and use it to supply chains, Mike. You know, right?
Yeah.
There's a thing, you know, that we would call contested supply chains, where an event occurs and you have to adjust in real time. Today, all those models are batch. You know, right? They literally take days to respond. And in some cases, that's okay. In other cases, it's not okay. You know, it depends upon what business, what industry you're in and how you're positioned, et cetera, et cetera. But if you really, this is where AI applied to that very complex problem of optimization can take all those inputs from the large language models and give you a real-time path to the future and cost it out and show you the economic implications. This is real. I mean, I know the guys that have built these systems. That one's real right now. It started with the governments, as you'd expect, because they have what they call contested supply chains, you might call battlefield, you know, what have you, right? Where you have to make a real-time decision. But that's very much there, and it affects supply chains. The other thing that we talk about as you look at these different regions, your partnerships are going to change, right? And in DSCI, they call this the constellation of value. But these partnerships, you have to look at those partnerships as you see what's shifting economically in these emerging geographies versus where you've perhaps been, you know, taking advantage of their natural large economies that grow. In the future, you have to make that investment, just like we made if you go back to 2005, 2006, into those 20 countries, right? Now, it paid off by the time I retired in 2011. And we saw the benefits associated with that. But fundamentally, it's the same sort of thing. You establish new partnerships. We had to establish different partnerships when we were scaling India or China than we had historically in those countries, or Brazil. I mean, I can take you around the world.
Yeah.
That's of no value. The broader thought, quite honestly, Mike, is this: those partnerships you really have to investigate and understand, because you're doing two things. One, you want it as market entry, because clearly you want to have the relationships with people that have presence in those markets, and you want it for resiliency. So those two factors now come together.